Good morning.
Good morning, Patricia.
Welcome to the investment meeting of the Teachers Retirement Board for March 9th, 2022. It's 2023.
Is that the first item of business?
Brian Berge, I'll take the roll.
Brian Berge, representing Mayor Eric Adams, present.
Thank you. Thomas Brown.
Here. Good morning, Patricia.
Good morning. Dr. Angela Green.
Present.
Allison Hirsch.
Allison Hersher, representing Controller Brad Lander.
David Guzanski.
Present.
Victoria Lee.
Present.
We have a quorum. I'll turn it over to the chair.
Thank you. Good morning, everybody, and welcome, and especially welcome Dr. Angela Green and Tony Giordano. Welcome to TRS Board. My pleasure. So we're going to start, I guess, with the Passport Fund fourth quarter 2022 performance review, and ask Roboton, Mike. Great. Thanks, Tom. Thank you.
Okay, so we did circulate in advance the fourth quarter report for the passport funds. We weren't going to spend too much time commenting on this, given we did cover off the performance at the last meeting, but I'll emphasize again what unfortunately was a challenging year for markets last year. And we saw a variety of dynamics in the market as the market acclimated to the higher inflationary environment and the Fed reacting to try to curb inflation. We saw the notable sell-off that we did in U.S. equity markets. We saw also a sell-off abroad in developed and emerging market equities. And then obviously for one of the passport funds where there's a portion of the funds allocated to fixed income, the rate rise last year was not a friendly move for the balanced fund, contributing to the negative market environment. As far as the overall performance, the funds were, as you'd expect, roughly in line with their benchmarks. Some relative underperformance driven by active management. It was a little bit of a I don't want to call it a paradigm shift, but a change in dynamic that we saw toward the later part of last year. Whereas for active managers in the first 9 months of the year, it was an extremely challenging environment as the market essentially threw the baby out with the bathwater. We saw many active managers lagging for that first part of the year. In the fourth quarter, we started to see that turn, which was, a happy thing to report. So if you look across the funds last year, we did see some active manager outperformance on a relative basis in the fourth quarter, and that's persisted so far into this year. So we'll make a little bit more comments about the beginning of 2023 there, but nonetheless wanted to speak at a high level with respect to those dynamics. And I'll pause there and see if there's any questions before we turn to January, given we've already discussed questions. So changing gears, I've put up on the screen the January performance for the passport funds. And you can see that for the first month of the year, you'll recall January was a fairly strong month for markets. U.S. equity rebound to the tune of about 6.9%. The international markets, that you can see the international composite benchmark, which we show here as a blend of developed and emerging markets, was up about 8%. And the diversified equity fund had a return of about 7.5% ahead of both of its benchmarks. Again, going back to the dynamic I noted earlier, where we've seen active managers fare much better over recent months. So active management from both the U.S. equity composite and the international equity composite, albeit modest for the international equity composite, still positive. So that's certainly something we're happy to see. That brought the trailing 12-month return for the diversified equity fund to negative 8%. Beyond that, still negative 12-month numbers across each of the passport funds. But again, a strong month of January. The balanced fund up about 3.25%. The international equity fund up just over 8%. The sustainable equity fund up about 9.8% ahead of its benchmark by about 150 basis points. And then the equity index funds each up about 7 and 8% respectively for the US and non-US index. So I'll pause there and see if there's any questions. Otherwise, we'll comment on February.
Sure. Questions? Okay. Thanks, Mike.
Thanks, Mike. Unfortunately, unlike January, we did see some challenges for the month of February. I think there were sort of renewed concerns around inflation, which sort of caused pretty much all the benchmarks to have negative results for the month. We saw the global market composite benchmark down by 2.58% for the month. So too was a diversified equity fund hybrid benchmark down by 2.58%.
Devin,
Yeah,
I
you
think
guys-
folks inside are not hearing you.
Oh, sorry.
Yeah.
Can you hear me?
Yeah.
Continue. We saw negative results as well in the balance fund benchmark, down by 1.69%, and the international composite benchmark down by 3.25%. The overall theme here has been that the narrative have changed from initially, in January, we were talking about soft landing to now more of a concern about central banks having a lot more work to do. The good news on our side is that, calendar year to date, we did see positive results still. So the losses in February didn't completely erase the gains that we saw in January. So we still are up year to date, but challenging month for the month of February. Pause if any questions.
Questions for Devin? Thank you, Devin. Thank you, Mike. So now we move on to the, let's see, to the asset allocation discussion.
No,
No,
I think that's,
yeah, is that?
oh, the one in the middle, I'm sorry.
Yeah, the asset allocation.
Okay. From
Yeah, I get, no, I guess that,
I think we just wanted, I don't think we need 10 full minutes, but I think we just wanted to make sure, since there's no need to vote for Valerie, right, at TRS, given it's part of the IPS, is it every 3 years?
Mhm.
Just wanted to note for the record that, and Steve, you can jump in here at any time, that we are beginning the process, the strategic asset allocation review process. I don't know, Steve, you want to walk?
Yeah,
through
thanks,
how
Allison. Yeah, so obviously with the change in legislation, it gives the potential to revisit the strategic asset allocation, also in accordance with the plan of every 3 years. So we've actually begun engagement. We're working closely with Mike and hopefully with others at Goldman Sachs. I think Mike's promised to visit in the coming weeks. We put together a team on our side to work with the 5 general consultants and certainly Rokutan in the case of teachers. So Ed Berman, who's sitting behind me, is actually going to be our point person for analytical assessment. And we also have the 2 DCIOs, Petya and Anash, on the team, as well as Robert Fang, head of fixed income, and John Mercerberg, head of equity. So we have a team in place. We have a timeline in place, but we're actually in the process of trying to work with the consultants on an operating plan. And we don't think this is a 10-month process. Although we were just talking to Mike, and I think, Mike, your preference is to hold off until we have the March capital market assumptions, and then revisit it in April and start working in earnest at that point. So still plenty of time. It's probably a 2-3 month process. I would love, and Tom, I know you mentioned earlier, board engagement. Obviously, everything we're working on together would be for presentation and consideration to the trustees. But if we want to have a meeting beforehand that specifically focuses on strategic asset allocation,
thank you, Steve.
we're happy to do
Steve,
that.
what is the operating committee?
Oh, sorry, that memo, it was for both internal within BAM purposes and external purposes. The operating committee within the Bureau of Asset Management, we have every Tuesday afternoon, all of the different leads for that crosses investment,
Risk.
IOs,
ESG.
risk, the back office folks, risk, admin contracts that meet every 2 weeks to get updated on what's going on, and that have not been edited for
Okay, I
just
see.
trustees. It was
Oh, I
also
see.
sent around internally to BAM that we'll update internally BAM staff every few weeks at those meetings.
Great, thank you.
Just to keep on track and make sure that we're progressing as planned.
So, Steve, then it is your intent that the board would, that you provide the board, we would provide input into the essay.
Absolutely, absolutely. The decision rights of the rest with the trustees.
Of course.
But I would imagine we'll put together a couple different options. Mike, does that seem to make sense?
Yeah, I think that's the typical
Yeah,
approach where
yeah.
we use a few different examples of portfolios to emphasize to the board the different themes we're thinking about looking at. And I think while ultimately there would be a recommendation to the board, that would be informed by the conversation that we're all having together through the process.
So it's not that you're gonna do this independently, you're gonna surprise us on the way.
Absolutely.
It's not in a private, like,
It's not a prize, we're part of the process.
Absolutely.
because I think in the past, what we've had, our process was where there was discussion and, I'm sorry, and input from the board during the whole
Yeah.
process.
So I think in the timeline, it's very clear that there are monthly updates and discussions with the board over the course of the process.
And get their input.
And then, right, there are monthly updates and discussions with the
Yeah.
board to get, that's a point of discussion, I
And
think.
how
to get-
would we be getting the monthly?
I think
updates?
either at board meetings
At board
or at board
meetings.
meetings, and then I'm sure there will be, like we've been doing consistently, periodic offline conversations with various trustees around,
So if we need more.
if we need more, we can always schedule more.
Schedule something, so that's a how in the way.
Yeah.
Okay, so just wanted to get on the record that it is a collaborative.
Absolutely.
Venture and we're part of the process.
And I want to clarify too, I think while the final recommendation would leverage the March assumptions, we're beginning the process and analyzing portfolios with our December 31st.
Yeah,
assumptions. Yeah,
But we will have detailed discussions at the board.
yes.
Yeah. What we'll start doing, if it's appropriate, next month, we'll start having monthly updates,
Sure.
just say what we're working on, some of the things we're looking at. And the process we're going through. So for example, I took 10 themes or things that I was concerned about or that I thought may impact a strategic asset allocation policy. Ed Berman took it and actually put it into 3 macro themes. So we're working with the consultants to see, how that's incorporated into, your thinking and.
Great, okay, great. That's good. We on, I'm sorry.
Thanks. So one thing that I think might be helpful as we start the process is, especially since there are some people on the board who weren't around. In fact, I think the majority of the people on the board haven't been around since we've done the last asset allocation, CIO included.
Yeah.
That maybe it'd be a good idea to almost do a little, recap and review of the last process that we did, what it was before we changed it, what that process was like, what was some of the thinking was, timeline on that, just so that way those of us who weren't involved have some kind of understanding of what was done last time, what the changes were. And then as we move forward, we have something to measure it up against, and also help refresh the memory of the people who did it last time, since it was 3 years ago and we're around the age where remembering stuff that happened 3 years ago is harder than it used to be.
Thank you, Brian.
Yeah, I just had a quick question of procedure. Sorry for being pedantic. So I understand that the IPS contemplates 3-year cycles of SAAs, so there's no need to pass a resolution. But this particular cycle, it has a novel feature in that it will involve the input of the specialty consultants with respect to their areas of expertise. Is there a need, I don't know if that's a part of the TRS IPS, is there a need to separately vote on that aspect of it, which I believe was included in other board resolutions?
I would say no, but.
No, all right, that's the question is answered.
The only comment I would have, and I know that Rokutan has responsibility for the strategic asset allocation review as a general consultant. But what we'd like to do is have the specialty consultants feel for you to feel you have access to specialty consultants, particularly given the changes to the basket clause legislation. It may provide opportunities for a higher allocation into private assets.
Yep.
So we wanted to make sure that Mike and his team had access to those specialty consultants, but ultimately it's your responsibility.
Absolutely. Yeah, no, and I would add too, while I think that was added as a formal part of the work plan, Brian, which you pointed out. We did, I recall in the last process, had a number of conversations with Hamilton Lane in incorporating and thinking about the private equity allocation. And in the past, I think we were a bit more divergent from them in terms of our view for the forward-looking returns of private equity. And so we had a number of conversations to coalesce around, what we thought made sense for this portfolio last time. So maybe it was less formal then, but it was definitely a part of the process too.
Oh, and to be clear, I think it's a good idea.
Yeah.
I was really asking a very narrow question about if authorization is needed.
I'm pleased with the conversation. To reiterate that the trustees are going to be an active part. The asset allocation process is probably the most important thing we have to do
Yes.
as board members. And I'm sure I speak for everyone that we want to get this right. And it's through this long process. I'm glad Allison provided the timeline and looking forward to working with you to achieve this. Thanks, Mike. Appreciate it. Any other questions about strategic asset allocation process? Great. Let's move on. So we're going to have a discussion on the net zero by 2040 plan. And who's going to be taking that? John Adler, I see up
That's
there.
going to be me, Mr. Chair.
Hey, John.
Good morning. With permission, I will share my screen.
Thank you.
Let me know if you can see it.
Mhm.
Okay,
We
great.
can.
Okay, so we're going to talk about the net zero implementation plan. Pleasure to be with you this morning, board members. So just to refresh the history here, in October 2021, the TRS board voted to set an aspirational goal to achieve net zero by 2040 across your investment portfolio to mitigate the systemic risks of climate change and consistent with your fiduciary duty. You at that time adopted the net zero asset owner commitment of the Paris Aligned Investment Initiative and adopted a preliminary climate action plan that required the development of a net zero implementation plan in a year. Obviously, it's been more than a year, but as we met with you over the course of last year, we thought it was important to take the time to get it right. And hopefully the plan that we're discussing today gets it right. The broader framework here is that our goal is to decarbonize the market or the economy, not just our portfolio, in order to keep fossil fuels in the ground, again, consistent with fiduciary duty. And recognizing that we can't do this alone, this requires collective action by all of the players, governments, regulators, companies, and investors to keep global temperature rise well below 2 degrees centigrade. So here is the sort of 4 buckets of the net zero implementation plan. And what I'm going to do is go through it sort of piece by piece. And if there are questions, please feel free to stop me and go through them. So first on the disclosure of emissions and risk. The plan calls for us to annually measure and report scopes 1, 2, and 3 public portfolio emissions and the progress of the plan. So let me just stop right there and ask whether you want me to go through the definition of scopes 1, 2, and 3, which I have a depiction of on the next slide. Okay, I'm not hearing anything, so I'm just going to keep going. The plan sets emissions reductions targets for scopes 1 and 2 of 32% by 2025 and 59% by 2030. That's from a 2019 baseline. And again, I'll go through that in detail in a couple of slides. We're not proposing that we set targets for scope 3 today because we really only have 1 year of scope 3 data from last year. So without more of a trend line, it's kind of difficult to set scope 3 targets that have any validity to them. So we're saying that the goal is to set scope 3 emissions reduction targets by 2025, that the board would do that. And then we also plan those emissions reduction targets are just for public markets, for public equities and corporate bonds. We also are going to develop interim portfolio emissions reduction targets for private markets, but we don't have the data yet. So once we get that data, we'll come back to you And we can discuss emissions reduction targets in that part of the portfolio as well. So this is the slide that shows the definitions of scope 1, 2, and 3. I know that many of you have seen this before and it's in the plan. If anybody wants me to go through it, I'm happy to, but otherwise I'll just keep moving. Okay, I'm gonna keep moving. Okay, so this chart shows the emissions reductions so far and what's planned. So from the end of 2019 until June 30th, 2022, the TRS portfolio, public markets portfolio, went down in emissions by 27%. And that is about 3% more than the benchmark portfolio, which only went down 24%. So the proposed targets reduce the emissions from 2019 by 32% in 2025. So that's only an additional 5% over the next 3 years. And then from 2025 to 2030 would take it down from 32% to 59%. So if you look at the how steep the line is, it was very steep over the last 2.5 years, less steep over the next 2.5 years, and then steepness increases again, but not as much as it was during that first period. Again, with the thinking that, you know, you get the low-hanging fruit, but then you want to keep making progress, but you don't want to be able to count on making progress quite as, you know, rapidly as we have done so far. If we can exceed those targets, great, but these are good. We believe these are good stretch targets, and they're consistent with the ranges that the net zero target setting organizations have set. Okay, I'm going to keep going. So I'm moving on to the next bucket, which is engagement for alignment and action. And this engagement is really the heart of how we intend to take action to achieve these goals. So here's the first piece, is that we want to increase the science-based targets in the portfolio to 70% of scopes 1 and 2 portfolio emissions by 2025. So we're currently at, Neha, help me out, I think it's 23% for teachers?
That's correct.
Thank you. So currently 23% of your scopes 1 and 2 emissions are from companies that have adopted science-based targets, which are the targets to put the company in line for a 1.5 degree temperature rise in the economy. The goal is to increase that from 23% to 70% by 2025. That's not the number of companies, that's the amount of emissions that's covered. And then that goal would go to 90%, which would include scope 3 by 2030. And to do that, we would engage the highest emitters in the portfolio and collaborate with other institutional investors around that engagement. We calculate that to get to 70%, again, help me out with the number, Neha, for teachers.
It's 108 companies.
108, thank you. There are 108 companies in your portfolio that if they adopted science-based targets would get us to the 70% threshold by 2025. So that's the corporate engagement. And then we also are going to engage with all of the managers and ask them to either have net zero goals or science-based targets and plans by 2025. In other words, that we want them by 2025 to set these goals and plans, not that they have achieved net zero by 2025. And then the last bucket in engagement is that we need to develop the just transition assessment and criteria. And the goal would be to come back to you by the end of this year with a proposal on that. That's part of the plan that you adopted in 2021. Okay, I'm going to keep moving. Just a little bit more detail on the manager net zero piece. Again, everything has to be consistent with fiduciary duty. And we want them to cover at least the assets that they manage for us, if not all of the assets that they manage. And we're asking them to cover scopes 1 and 2 and material scope 3 emissions. Material scope 3 emissions are considered if scope 3 is at least 40% of the company's or the portfolio's emissions. And if they don't have adequate data for scope 3, because scope 3 data is very much still a work in progress, that they would develop a plan for that. And then for general partners, that is in like private equity or other private markets investments, there's been some pushback on setting a net zero by 2040 or by 2050 goal because, you know, the funds only have a 10 or 12 or 15-year life. And so they say to us, not without reason, well, we don't even know what we're going to own in 2040 or 2050. Nothing we own today is still going to be in our portfolio then. And so the fallback then is to say, okay, then have the companies that you control adopt science-based targets while you hold them. And that would actually have a real world impact if you don't want to set an overall net zero goal for the firm or for the fund. So here's the things that BAM commits to do as part of this manager net zero alignment. We need to develop a proposal for non-control investments because that last piece I just mentioned is for control of investments. What about investments where our manager doesn't control the holding company? What can they do in that case? And we would have discussions with the managers with ideas about that. We want to review the proxy voting records of all of our public markets managers. We historically, you know, we do our own proxy voting, so we don't really bother with them, but how they vote their proxies certainly has an impact on climate issues and net zero. So we want to review that. We will provide you with an interim report this year on where the managers are at, an in-depth progress report next year, and then in 2025, if there are managers who have not agreed to set targets or plans, we would recommend come back to the board with recommendations for what actions to take or some acceptable alternative approach. All of this, of course, subject to board review. Okay, I'm going to move on. Climate solutions. So this is essentially unchanged from what you already have approved, right? The 2025 goals, the 2030 goals you approved in 2021. This number here, 2.2 billion, is the amount that you have currently in terms of exposure to climate solutions investments, and it represents roughly 2.5% of your AUM as of June 30th last year. The goal is to get to 4% or 4.2 billion by 2025. So that's, you know, what we're working towards. And one of the things that we want to do is assess, is there a way that the strategic asset allocation is constructed to prudently increase allocations to climate solutions investments across multiple asset classes? So that's something, you know, that the team, and that means, you know, the consultants, BAM staff, and of course the board would take a look at in the course of doing this asset allocation review that you just discussed a few minutes ago. Okay, and then this is the last slide in terms of thinking about exclusions. In private markets, when the board approved fossil fuel divestment 2 years ago at the beginning of 2021, you asked BAM to come up with an approach for that in private markets, because that was just for public markets. And so the proposal is that we ask all private markets managers to exclude exploration, extraction, and production of oil, gas, and thermal coal, or provide an opt-out of such investments. If the manager does not agree, then we would bring that to the board's attention, and the board can decide on what action to take. I will just tell you that informally, whoops, I blew that, here we go again. Informally, our private markets managers are not in this space anymore. It's not consistent with their risk return objectives. So we don't expect this to be an obstacle in any of the asset classes. And then in general, if managers or companies fail to comply with the parameters to align with science-based pathways to keep us to 1.5 degrees Celsius, then the board will decide what to do, which, consistent with your divestment and exclusion policy, where, engagement is preferred, we will engage. And then if engagement proves futile, then the board can decide what, if any, action to take. So that's the presentation. Any questions? I'm happy to address or open it up for discussion.
Thank you, John. Do you have any questions for John?
I'll stop sharing my screen.
Brian?
Yeah, I just have a quick comment to thank John and his team for their work on this document, and for their work in general in keeping TRS really on the ball in terms of what is an obvious global risk to the potential performance of our portfolio. I would also like to note that John and his team were also very helpful in engaging with our concerns from MOPI about certain aspects of this. We really grilled the team on just how these targets were developed, what the methodology is for, developing the numbers themselves. My impression is that this methodology is still being refined to a certain extent, even for scope 1 and 2. And I would encourage BAM and this board to not be unduly rigid or adherent to what is, the path right now. If it turns out that, as the methodologies are refined, different paths become preferable. This is kind of an area that is evolving pretty quickly. And I think that's understandable. That's not mentioned as a criticism. I'd also like to note that we worked pretty extensively with John and team on the divestment language, which I think in its current form, we feel really makes clear that for something like this, engagement is the key. We're engaged really in an effort to try to change along with the world. And we have to be careful at all points that we've really had conversations to the fullest before we talk about, turning our back on any given company. There are a lot of difficulties that certain companies might face that aren't the same, just based on their sectors. And we have to be mindful and sensitive to the scope of the change that we are hoping to help achieve here. So, but I think in the current form of the document, which is uploaded, reflects our changes, and we're certainly supportive of the initiative going forward.
Thank you, Brian. Any other questions, comments? Are we ready to take a consensus?
I thought this was
just
a discussion.
No,
Just a discussion.
Oh,
we weren't voting.
Yeah.
This was meant to be a vote today.
It's just, I have it on.
Do we want to lay it
What are you
over?
voting?
What?
What are we voting on?
We're voting on the net zero plan, implementation plan that is in convene. That was our,
This implementation plan require a resolution at the board to go through, or is this something that we can just do via consensus at the investment meeting?
I would think it's a resolution.
Yeah, you did.
I mean,
a
everything we vote
resolution.
on here, we then approve at the board, right?
No. No, not specific investments. Those are done by consensus. There's the overall delegation to the Controller's Office of Investment Authority and consensus just on individual items. I do believe that there was a resolution on the initial adoption of the goals or agreement to the goals, so probably appropriate to have a resolution on the plan. Sorry, we had this as a discussion item and we didn't know, and we could do that for the next board meeting if the board desires.
Okay.
Next board meeting is our next Thursday.
It's Thursday, right?
Okay.
So do we need a consensus if we're going to do a resolution? Should just do it later?
Yeah, so hearing that you're requesting that there be a resolution for the next board meeting to adopt the implementation plan. So we'll prepare that.
Okay.
Or the Controller's Office will
Yes.
prepare that.
Could you clarify something? So when we do consensus, it's just on investments, it's not on. Like, if you're gonna have a resolution, you don't need consensus, because you're gonna have a resolution on like a net zero plan.
Correct.
Right, so you don't need consent, like usually you do consensus on individual investments.
What I think I understood Tom to say is the board is requesting that the resolution be prepared.
Okay.
So we don't need the consensus. That's the resolution. states
The
that we
resolution
want
will
to
take
go.
care of, yes.
Okay. Any other questions? I think we'll move on to the next item on the agenda, the pension fund performance update, quarterly presentation. And I guess that's the controller, Steve. Wait, do you get to that?
Thank you, Mr. Chairman. Kate, is it possible to pull the slides up? Thanks, Kate. Well, I mean, maybe just a couple comments up top. I'm gonna basically echo what Michael and Devin have mentioned earlier. 2022 was a very challenging year for the US economy as well as the global economy and certainly financial markets. In the States here, we saw slow economic growth. Remember, the first and second quarters had negative GDP growth. We had a peak in CPI inflation in June of last year at 9.1%. We saw substantial declines in prices of both bonds and stocks in tandem, which is unusual but not unprecedented. We had elevated geopolitical risk associated with Russia's invasion of the Ukraine. We saw a changing dynamic between the US and China, which is ongoing. And we had the most aggressive Fed rate hikes in 40 years, so a challenging year. Unfortunately, I think 2023 is likely to be another challenging year for both global economies as well as financial markets. And I'm going to take a quick look, maybe do a little bit of a deeper dive into the conditions, past and present, that'll drive those assumptions and some outlooks for financial markets for 2023. Next slide, Kate, please. So obviously, inflation is a primary concern. It's been high and elevated here and abroad. In the Eurozone, it's come down a little bit off the boil, but it's still over 8%. In the UK, still high. It's come off of over 11%, but it's still above 10% through January. And as Fed Chair Powell reflected at the last Fed meeting, the disinflation process has started here in the US. Although with recent strength in many key indicators, I think he's trying to walk that back a little bit. On the next slide, take a look at US inflation, both CPI and the Fed's preferred measure, the PCE deflator. They both come down. You can see CPI has come down nicely. It's still a little bit over 6%, which is much higher than the Fed would prefer. I think the more important aspect of this note is if you look at the PCE deflator, that yellow line, it's still sticky at around 5%, slightly below 5%. And I think that's going to be more of a challenge for the Fed going forward. And we have a new CPI print early next week to give the Fed a little more information. And the next slide, US core CPI is sticky at around that 5%. And I think that's going to persist. And you can see here are measures year over year, 3 and 6 months, and they tend to cluster around 5%. So assuming that the Fed continues to raise rates and their policies take hold, I expect to see that decline, but it may be sticky around 3 to 4%, which means the Fed's going to continue to raise rates and keep those rates higher for longer than I believe the market currently expects. On the next slide, a quick look at US, Eurozone, and UK inflation. They're all moving directionally in the right way. But I think that far right-hand side of the slide reflects that there's a lot more work to be done in all three economies. On the next slide, the drivers of inflation are different here versus what we're seeing in Europe. On the left-hand side of the slide, you can see US inflation is really dominated by services inflation. That dark blue component is actually food and energy, which is a smaller component of inflation here, but it dominates on the right-hand side in the Eurozone. And that has to do a lot more with the Russian invasion of Ukraine and prices of energy and secondarily food price increases there. So again, different drivers, but the same result with inflation being high. On the next slide, just a look at the key drivers in the States. You can see that green line as it comes down, that's goods inflation. So goods inflation is getting back to where it should be reasonably lower. And that's more reflective of those supply chain bottlenecks going away and the economy repairing itself. I think the disconcerting aspect of this slide is that the service sector, you can see that's a line that continues to move up at a little over 7% service sector inflation. And we are a service economy, so that's a challenge for the Fed. On the next slide, expectations for the next year based on the University of Michigan survey have come down nicely, as you can see that, but they're still at 3.9%, which is much higher than the Fed's target of 2%. Now, some of the drivers on the next slide. So we had a monster employment report for January that was published in early February. We have another February employment report, non-farm payroll report, tomorrow morning at 8:30, which everyone's going to be looking at very carefully. But in January, the unemployment rate hit a 53-year low of just 3.4%. And it was referred to as being stunningly good. Again, that's a challenge for the Fed, and that was well above expectations. On the next slide, you can see where that inflation is at 3.4%, that far right-hand side. I think what's more interesting, though, is that 3.4% unemployment rate occurred while more people were coming into the labor force, which is a positive development. But that moved up to 62.4%. We continue to watch that. And I'll show a slide in 2 slides. I'll describe why. The next slide, the inflation pressures we're seeing here are really very focused on the services sector, as I reflected earlier. On the far right-hand side, you can see healthcare services, professional services, and lastly, leisure and hospitality are really driving inflation higher. On the next slide, this is a look at why we think that the improvement in the participation rate may help the Fed in terms of slowing the economy. We still have a fundamental shortfall, or I should say a structural shortfall of workers. We have 11 million open positions and only 6 million people unemployed. So that 5 million person gap has to be narrowed over time. Again, hopefully with an increase in the participation rate in our economy. On the next slide, a look at economic growth. Remember, we had first 2 quarters in the US of negative economic growth. The fourth quarter actually came in, early expectations were 2.9%. It was revised slightly lower to 2.7%. So still a little on the sluggish side. We have had some positive news on the lower left-hand side. You can see the headline. As China reopens their economy, it's expected to help both the US and European growth. However, China was expected to come out with a growth forecast and expectation of over 6%. And their stated goal for this year is just 5%, which disappointed the market somewhat. On the next slide, again, it's a reflection that the GDP growth around the world is starting to stabilize after a period of multiple years where it was very tumultuous. Again, primarily driven by the pandemic. Consumer sentiment on the next slide. This is an interesting slide, and it kind of touches on something that Devin said earlier. We had a great January. Markets rallied, stocks were way up, bonds were way down, yields were down. And as a result of that, we saw more people start to look at houses as the 30-year mortgage rate came down almost 100 basis points. And you can see that increased on the far right-hand side. That upturn is interest in people just traffic and looking at homes for sale. I suspect that'll reverse itself because we've had almost 100% retracement of that rally in rates, and mortgage rates are now closer to 7% than 6%. Investor sentiment on the next page. This is the most anticipated recession of all time. These are professional forecasters that 45% are expecting a recession in the coming 12 months. I suspect there's probably a higher likelihood that we are closer to having a recession than not. A lot of people will say it's 50-50, which isn't really any kind of a forecast, but I don't think it's evident, but I think it's perhaps likely. On the next slide, we look at 4 basic economies, the UK, Eurozone, and the US. Those are up on the right-hand side, and expectations are for recessions in all 3 of those regions, with the outlier being China on the far right-hand side. Again, coming out of COVID, relaxing the COVID protocols, that economy, again, is expected to see a 5% growth rate in 2023. On the next slide, just a look at why we had such a substantial backup in global interest rates. Again, concerns about a 1970 style inflation pressure, I guess, which most of us haven't seen. Unfortunately, I remember it too well. That was when tuna helper showed up on the Meyer family dinner table, followed quickly by hamburger helper, and I don't know which was worse. But interest rates in the UK and the Eurozone are expected to be raised by another 50 basis points. Those central banks have already telegraphed that. The Fed has intimated or indicated its intent to hike rates at least another 2 times. I suspect, given recent strength, depending upon what employment looks like tomorrow and CPI looks like next week, they may even have a little bit more to go after that. On the next slide, just a look at where we are on the rate hiking cycle. On the far upper side, we're at 475, 450 to 475 official rates. Financial conditions actually have eased a little bit with again, that January rally in stock prices, credit spreads tightened, and rates came down. So again, that makes the Fed's work a little harder. On the next slide, just a quick look at, again, that very quick pace. The red line is the pace of rate hikes for 2022 into 23. Like I said, there's probably at least another 2 coming and perhaps another 3 or 4 coming. And we look at this, traditionally, you parallel that to that blue line, that's 1994-95, when we had the issues with Orange County's bankruptcy. They owned inverse floaters. As rates went up, their funding costs went up materially. I should say they issued inverse floaters. On the next slide, look at financial conditions here and abroad. The white line is in the US, and those financial conditions are pretty close to neutral, or at least they're positive. Financial conditions are much tighter in Europe, just at a negative 3%, 3.1. Quickly looking at credit spreads and treasury yields. Again, the bonds rallied significantly in January, only to give it all back, and then some in February, and that's continued into March. So far, year to date, we had rates that started the 10-year treasury yield, began the year at 388, went down as low as 335, and then is now at about 4%. So again, a challenging time in the market. The lower right-hand side, it talks about the yield curve inversion. That means you're not getting paid a premium to invest further out, and quite the opposite. So right now we've got 2-year yields at about 5, a little over 5%, and 10-year yields at just 4%, which means you're earning a lot more in a 2-year obligation if you buy treasuries versus 10s. Next slide. That's just more of the same. It shows the yield curve through the end of the year in red. You can see the inversion on the far left-hand side. And again, the inversion on the right, which reflects at about 80. And that's increased substantially in the last couple of days, given Chair Powell's testimony and concerns for additional rate hikes. Quick look on the next slide at just the 2s and 10s. And again, the market continues to move, but in green, those are the 10-year yields, and in white, the 2-year US Treasury yields at 488, well above that near 4% level. And that actually indicates that the market's expecting a recession in the near term, and then rapid rate cuts following that. So we'll see. Next slide looks at credit spreads. So I think credit spreads from a high yield standpoint, which are in yellow, at about 400 basis points over comparable US Treasuries. And on the white, those are investment grade credits at about 120 over. I think they're fairly valued for an economy that is not going into recession. I don't find those levels to be compelling from a buy perspective. And we'll see how those trend over the coming weeks and months. On the next slide, it's a quick mention, the dollar is off the boil, but it's still relatively strong. It's still strong based on historicals. On the following slide, we look at the three big currencies that it's typically looked at. So up top, the euro now buys $1.06. It used to buy only 93 cents in the latter part of last year, in the fourth quarter of 2023. The pound sterling now buys $1.20. It got as low as buying only $1.03 in the fourth quarter. And lastly, the US dollar buys 136 yen now, whereas at the end of last year, it was close to 150. So again, the dollar is weakened somewhat, but it is still relatively strong. On the next slide, a quick look at stock and bond market returns. And I don't mean to beat a dead horse here. It was a tough year. S&P 500 lost over 18%, closer to 20%. Bonds had one of their worst performing years in over a century. I don't know how they get these figures, Mike. Maybe you can tell me, but I saw a quote that went back to the 1780s. Said this is the worst bond market since the 1780s, and I didn't know we had. I don't know. Yeah. So, what I really like to say on the next slide, Kate, the far right hand side. The last quote, the bond rate of 2022 ends the golden age for fixed income. Well, fixed incomes benefit from a 40-year secular decline in interest rates since the 1980s. And that seems to have come to an end. I think the zero interest rate policy probably put a stake in that statement. Next slide, just to look at world bond markets over the past 12 months, we have had a dramatic move up in yields. And here I'm looking at the far right-hand side. So up top, those are US Treasury 10-year yields for the last year. They're up at 211 basis points. That's a big, big move. And across the board, all the way down in every developed currency, these are sovereign, comparable 10-year sovereign yields. They're all up pretty massively, with the exception of Japan, which is moving in that direction, and China, which was suffering from very slow growth and an easing monetary policy. On the next slide, a look at volatility. Left-hand side, that's the VIX. That's a measure of implied volatility for equities. Below that green bar, it's typically risk on at below 20, and above it, over 30 is typically risk off environment. We're right about 19 or 18 today. On the far right-hand side, which is more interesting to me, well, I shouldn't say that as a bond person, but it's more interesting is that the level of volatility, this is a move index that looks at volatility in treasuries, implied volatility. And on the far right-hand side, you can see it's still well above its historical 30-year average. The next slide basically just underscores what I said. The green line up top is the move index. So it is significantly higher than the VIX, which just indicates, again, where inflation is and where monetary policy is going, where rates have been, more volatility relative to historicals for interest rates. Very quickly, market returns have come back a little bit. On the left-hand side, you can see the UK, Euros, developed market ex-US and US, sorry, the US, developed market ex-US and emerging markets. They've come off the bottoms, but they still have a ways to go, we hope. Far right-hand side, that's the Barclays US aggregate, and it's come off of its lows seen in October. The slide's a little stale because I think there's been a retracement on the downside as well. And with that, maybe move ahead 2 slides, Kate, one more, please. And the question is, why is a recession always 6 months away? Well, the economy actually is relatively strong. As you saw earlier, GDP growth around the world is starting to normalize, coming off of those tumultuous post-pandemic years. So that we still have positive growth, and the labor market in the US is very, very strong. And that's, again, we'll get another read on February non-farm payrolls tomorrow. But rest assured, the market and the Fed is looking at these very carefully. Food for thought on the next slide. Just this looks at, it actually overlays inflation relative to where we were in the 1960s and 70s and early 80s. And basically the takeaway here is from peak inflation to where it got down to a more normal level on those 2 cycles in the 1980s, the 70s and the early 80s, it was about 2 years. And that's just an example that we have probably a long ways to go in terms of getting inflation under control, which means the Fed is going to keep rates elevated probably for longer than the market expects. And the last slide before I get into performance, this is why everyone talks about the pivot. Everyone's so anxious for the Fed to stop raising rates because traditionally on average, when they stop within the next 12 months, the S&P 500 goes up 15%. So we traces some of the losses. We'll see what pans out this time. Taking a look at performance, I'm going to try to focus on the fourth quarter because it was relatively strong. One more, Kate. And you can see that evidenced by the Q4 22, positive across the board with the exception of the very, very long duration fixed income assets in the middle. But other than that, we had a nice recovery off of a really bad year, which still ended within 12 months, a poor outcome for all manner of public markets, both equities and fixed income. On the next.
Steve, could I interrupt you just for a second?
Yep.
So you were talking about yields before, and now and you mentioned the long-term duration is not doing that well. So one of the things that we implemented several years ago was to build out our long-term duration, and then we've ratcheted it back since. Is there a need now to revisit that and bring the duration down even more? Or is where we're at kind of fine? And what do you see going forward?
Well, rates have moved up nicely, so I don't know that it's the right time to be reducing duration right now. I think there's probably a little bit more upside, but at some point the Fed will pause and hopefully inflation will continue its downward trend. It depends how quickly, but I don't know, Mike.
Yeah, no, I agree. And I think the other thing to think about, which will be part of the asset allocation review, is you're getting paid a lot more for fixed income today. The yields are a lot higher than they were 3-4 years ago. And, you know, while we didn't see the diversification benefit that the added interest rate exposure we would have expected to have provided last year, you know, I don't think we've changed or revisited. We haven't changed or revisited the perspective that over the long term, we expect fixed income and duration to provide diversification for equity risk, of which the portfolio has a lot, right? So, but that'll be a key item that we review as part of the SAA.
Okay. So this is your allocation of cash in your portfolio. It's to be more strategic and focus more on long-term returns. But right now, cash is yielding. We've got 6-month T-bills are yielding over 5%. So we always have some level of cash to meet benefit payments as well as capital calls. We had a rebalancing meeting yesterday where we discussed perhaps raising a little bit more cash tactically, only because we don't want to be raising cash for distributions or for capital calls at the end of the month, at the end of the quarter, given the volatility, and you're getting paid to wait. So we may inch that up a little bit, but that's really in the magnitude of near 1%. It's not above its normal range.
Thank you.
Sure. Next slide is Kate. Thanks. This is don't want ahead. That's good, Kate. Yeah, thanks. Just a look at where we are for the net private manager returns. You can see looking at 1 year, again, the information doesn't bounce around as much. The mark to markets are less volatile, but you can see even in the 1 year second through the end of the year, private equity, all manner of private assets have generated a positive return. So again, a good outcome. And certainly, Mike just talked about fixed income providing that ballast for a portfolio. And it is unusual. 87% of the time, bonds and stocks don't move in tandem. This is one of those 13% where they did. So a challenging year. But the good news is we have a material allocation of private assets, which provided, again, that offset and a little more ballast for the portfolio. On the bottom part of the slide, you can see the total Teachers Retirement System plan return for the 3 months was 5%, relative to its policy return of just 4.9%. That's really rounding. I think they were pretty within a couple basis points, a fraction of a basis point. So pretty close. The next slide actually looks at that attribution. And like I said, we kind of wiped each other out, but investment manager selection on the far right delivered about 40 basis points of return. And some of the asset allocation effect was, we would just happen to be slightly overweight to private markets, which in a volatile period of time provided that offset. On the next slide, I'll look at your public market excess returns. By asset class, you can see that we had a little bit of a drag in our relative to the Russell 3000 in equities. World US, ex-US was up, emerging markets recovered fairly well. And again, the fixed income was still a little bit of a lag, but overall, on the bottom, the total teachers retirement system relative to your policy benchmark was up a couple basis points. And I'm 2 more slides and I'm done. So one next slide, just to look at the private market excess returns, and they were substantial. In private equity for 1 year was 2,086 basis points. Again, that has more to do with the Russell 3000 selling off so significantly. But again, the private equity allocation was positive for the year and dramatically outperformed that benchmark. We had a little bit of headwind for the non-core real estate, which tends to be higher risk. It's opportunistic and value added. I know sometimes they attack a spread, the non-core of 200 or 300 basis points. Here there isn't. So underperformance in that one area. But again, I'm sure Mike would agree. Typically, you want to look out 5 and 10 years to look at the excess returns, which are substantial for the asset classes. Lastly, just rebalancing. So there was a little bit of activity in the fourth quarter this year. Most of it was really to raise cash for benefit payments and to meet capital calls. A little bit of a rebalance as well. I know that John Mercerberg was rebalancing the equities, not just to raise cash, but also to fund the PIC Day Climate Solutions mandate in the fourth quarter. And Robert Fang was doing a little bit of rebalancing around credit mortgages and intermediate term treasuries as well as raising, again, $980 million in cash. And last slide, total portfolio over and underweights. They're consistent with benchmarks. And again, we try to adhere pretty closely to the targets relative to the cost of rebalancing and market conditions. So with that, there's a lot of information. I'll open up to questions. Arnie?
You have any questions?
I've got a question about, since so much of what might happen in the future is based on the Fed, and with Brainerd moving over to the White House and the possibility of Eberly or perhaps somebody else, is that going to materially change the thinking in the Fed? Is Eberly's voice, or if it's not her, someone else, going to push the Fed to be more or less aggressive?
Yeah. I don't think so. I think that the policy would probably be pretty consistent. Eberly is obviously very qualified, having a PhD in economics from MIT and a wonderful career. So I don't know that she'd be have a different perspective. So I would expect the policy to continue the way it has. Again, tightening and focusing on fighting inflation. But you're right, you're absolutely right. A lot of what happens in the financial markets is driven off of what the Fed's doing with official rates. So again, I think we're closer to the end of the hiking cycle than we are to the beginning, a lot closer, but there's still maybe another 100 basis points to go. I think at least 50, which is what the Fed's indicated. And I think given the recent strength, again, maybe another 1 or 2 after that. But at the next Fed meeting, we also get the summary of economic projections, or the dot plot. And what everyone's going to be focusing on there is what's the median expectation for the terminal rate of Fed funds. Last time it was 5.1%. Oh, sorry. Last time it was 5.1%, and the expectations will be something north of that, probably close to 5.6.
Yeah, we're forecasting 5.5 to 5.7.
There we go.
So, right, you split the difference.
Yeah.
It's interesting. I don't know, Stephen, how you feel about this, but it feels like the market is more so now than ever hanging on every word that comes out from the Fed. So it's pretty interesting to see the swings reacting specifically to whatever language there is out there.
Yeah.
From Chairman Powell or others.
Yeah, it's really important to look through the noise. So we come in front of the board of trustees on a monthly basis, and on a quarterly basis, more formally, to go through this. There is a lot of noise out there. It's data dependent. The noise jumps around. I mean, there's an argument that can be made, and we'll see on tomorrow morning. But was the last the jobs report tomorrow, and frankly, there's some school of thinking that there were seasonal adjustments to the January numbers that maybe made the economy look that much stronger, the job markets that look that much stronger. So we'll see if there's any offset against that. Right now, the summer survey expectations for tomorrow's increase in employment is 225,000 jobs versus 517,000 in January. But those are the numbers that the Fed's focused on. But as trustees, it's hard because, and as a CIO and as a consultant, we're trying to focus on 5, 10 plus year returns and where we think we want to be. Your strategic allocation is actually meant to perform over various cycles. There is a lot of noise out there, and I hope we don't compound that by coming here and talking about every little number. But what we try to do is look through the noise and figure out what the right signals are. And those signals will actually impact how we think about the strategic asset allocation as the recommendation we give to the trustees.
Any other questions? Thank you, Steve. Well done, well presented. Is there any reason why this is a 6-week lag? Is this information available any sooner to present to us, or is there a reason why?
It's usually it's reported by our custodian State Street. They don't give us audited accounting statements, performance statements, but once a month. But we're in the process of going through a new custody RFP process. My hope is that we'll be able to get daily pricing. We have daily pricing, but it's not audited. But we do think that's something that we need, and we do think that's something that State Street or Boeing, whoever responds to the RFP, can potentially deliver. So we hope to have better information faster.
Good.
Around the privates, though, they are reported with a significant delay, and that's just market convention. So the private asset performance numbers you saw today.
What delay would that be?
From September 30th. It's usually one full quarter. And that's not just here, it's everywhere.
Okay, thank you. Thank you, Ed. Sorry about that. And Ed Berman will now do the risk update. Thank you.
Please let me know the sound is it's a big room.
Yeah, we hear.
Okay. We'll be talking about risks today, and so obviously your portfolio is more than 90 billion assets. It reaches across the entire globe in all asset classes, multiple managers. So a lot of things happening, right? So you're subject to markets, subject to what's happening in the managers, subject to the balancing. So all of this we call risks, and it's impossible to eliminate all the risks. It's actually good for the portfolio. That's how we generate returns. The objective is to get risks consistent with the investment process and with the policy statement. So over the next 20 minutes and several pages, I'll try to address two questions. First of all, are the risks in your portfolio consistent with the investment policy statement as it's today? And second, looking forward to the possible future, will the portfolio perform the same as we expect? So at the first point, we need actually to define what risk is. And it's not a simple question. There's no unique measure of risk. But for a large multi-asset portfolio, we usually define risk in terms of performance. And we define it in terms of the expected performance. And much like there are two measures of performance, we usually talk about total performance, absolute returns. We talk about excess returns. Much the same, there are two measures of risk. We talk about total risk, and we'll talk about active risk. So you can see on this page that your total risk for the quarter, at the end of the quarter, stood at 12.4%. But what does this number mean? So 12.4% means that you may expect over the next 12 months for your portfolio to deliver a 12.4% return. There's a catch to it. We assign about a 70% probability to this outcome. There's a 15% chance that the returns will be better. And there's a
what percent? 50?
15.
15. Oh.
And about 15% that the returns will be much worse. But the most important question here is, what drives this number? Is it a good number? What is the intuition behind this number? Is it something you need to worry about? So broadly speaking, there are three main factors that contribute towards the risk in your portfolio. it's the markets, it's the portfolio construction process. And it's anything that the manager do, the balancing, the cash flows, all the technical will go into day-to-day management of the portfolio. So to understand this risk level, we'll take it in these steps. First of all, the markets. We represent the markets by a simple blend, 60-40, 60% equities, 40% fixed income. And we use MSCI World for equities and Barclays Act for fixed income, which is the closest match to your portfolio. You can see it in the first column on the market portfolio. Despite the enormous size of your portfolio and many dimensions, there are three main buckets of risk that you take. That is equity, rates, and credit. And you can see it at the top of this page. Actually, I have points, so it's much easier. So you can see that the asset allocation is 60%. Interest rate duration is 2.5 years, and the spread duration is 1.5. You see there's no change, obviously, because this is our baseline. So what does it mean for risk? So this is market, this is our baseline. And we run this portfolio through our risk system, bar one, and it gives us the outcome. So the risk is 11.8%, meaning that we expect the performance of this market portfolio over the next 12 months to be within a 11.8% range, and was slightly up for the quarter. So this is our baseline. This kind of frames the entire discussion. This increase in risk was driven entirely by markets, and that's what markets delivered to us. And related to that, there's a second measure of risk that is beta to the S&P. Remember, I mentioned that the total risk is framed in terms of 12 months expectation. So the beta is more of a short-term measure. So beta, it measures how much your portfolio will move to the change in the S&P. And 0.57 means simply that a 1% move in the S&P translates into a 57 basis point performance move for the portfolio. And that includes everything, your credit allocation, private markets, public markets, everything. So now that we have this baseline, we can continue our journey and understand what the risk levels for the portfolio means. So the next step in the process is to split this equity and fixed income into more granular buckets. That's what achieved by the strategic benchmark. Right, so your benchmark has 11 components. You can see it at the bottom of the page. And you'll notice that the portfolio construction changes slightly, right? So you can see it on this side of the table. So you have slightly more equity allocation, 2.5%, meaning slightly more risk, more return. You see that the durations slightly lower, so you think less interest rate risk and less credit versus the market portfolio. What does that mean for risks, for your benchmark? You can see at the bottom of the page. So the risk actually came down slightly, but you can see how consistent the risks are between the benchmark and the market portfolio. You also see that the beta also came down slightly. We're talking about small changes. So just think about it. We now have slightly more equity, meaning more risk, more expectation of returns, but the risks came down. It's a good thing. So it means that the asset allocation is working as it should. So it's a good affirmation. And now we can move to your actual portfolio, which is shown in the column 3 of the table. So first of all, you can see that the equity allocation is closely aligned with the benchmark chart. You can see that the duration, both rates and credit, are fairly close, but there are small differences. That's mostly because of the ETI allocation brings different duration profile. Again, we know about it and it's not a huge surprise. So what does it mean for risks? You can see that the risk level, again, is broadly consistent with the benchmark and market portfolio, but not slightly higher. Why is that? We'll answer this question later. I'll give you a brief preview. Private markets, mostly private equity, but we'll dive more into details on next pages. You can see that the data, again, ticked up slightly. We're talking about small changes. So we know that the risk levels in the portfolio are running slightly higher than the benchmark. There's have implications for the performance and the potential down markets. And here we introduce the third measure of risk, which is active risk. Remember, I mentioned that the risk in terms of performance, there's absolute return and excess returns. So this is a measure of the excess return over the benchmark. It means that you may expect the portfolio to deliver about 2% in excess returns. Again, It's a good thing. That's what we expect. And it's consistent with our asset allocation process. So what are the main takeaways from this page? Actually, I think that this is probably one of the most important pages in the entire presentation. This is your high-level check of the calculated portfolio and what everything summarized to a single number. So first of all, you see that the risk profile of your portfolio is closely aligned with the benchmark as intended. Check. You can see that the changes for the quarter were driven mostly by the markets. And we're now going through a difficult market environment, volatile and turbulent, which we expect will revert at some point. We know that the expected performance of your portfolio is driven mostly by the markets. And why I say that, because we just compared this number against the market portfolio, they're very close. So markets is the most important input in the returns of your portfolio. And we also say that there were no unexpected changes in the portfolio for this quarter, which is an important conclusion. And why I say that, I'm looking at these two charts in the left corner of the page. And these charts show the last 12 months of history of all these three portfolios we just talked about. And you can see that the relationship between these portfolios stayed the same for the last 12 months. So at the high level, you can say that the portfolio is mostly unchanged in terms of its profile. You also see that these lines were trending up through the year. That's again not surprising, it's the markets. Okay, so we know that because of the pandemic, everything these people are just talking about, we're in a historic, very volatile environment. So these levels move up. It's not surprising, and it's not to be expected. You can see that it's started bending down slightly, and that's again a reflection of the market side. And finally, the last point to make on this page, active freeze, which is a measure of excess returns. Again, broadly the same. It's bouncing about between 1.5 and 2%. It went up recently, but mostly because of the market volatility. So no big surprise. Next, we'll dive more into the portfolio and see what's inside these numbers to give you more intuition, more sense of the portfolio. Can we have the next page, please? Thank you. So, much I mentioned before, there are two measures of risk: total risk, absolute returns, and active risk, excess returns. Now you have two charts. First of all, let's focus on chart number one on the right-hand side of the page. Just to remind you, the total risk for your portfolio runs at 12.4%. But what are the components of this risk? What drives it? You can see it in this chart, and that shows again the last 12 months of history. So you can see the evolution. First of all, I just said that your portfolio is mostly 60-40. You have actually 62% allocation to equity. But first of all, that jumps out of this is this huge green band in the middle of the page. So equity, even though it's only 62% allocation, drives the majority of your risks. In particular, public equity, the green band, is only a 45% allocation, but it's 66% of risk. The other takeaway is this blue band, private equity. So private equity runs at about 8.5% allocation, but contributes 17% of risk. Intuitively, it makes sense, right? So just as Steve talked about the performance, private markets was strong contributor. What about fixed income? It's this small orange band at the top. You can barely see it. It's only 6% of risk. There are two things noticeable about it. First of all, it's thin. That's actually not that surprising. It's actually typical for multi-asset portfolio. What's notable here is it's on the positive side of this chart. There's nothing on the negatives. There are no detractors, no diversifiers. And that's unusual. Again, going back to what Steve was talking about, that's where we talk about the positive stock-bond correlation. Stock and bonds move together. This is unusual. It's actually typical for a high inflation environment. We get the same in the 80s and earlier, whenever we get inflation. And we expect this to revert. As inflation comes down, we expect this diversification to come back, and we expect fixed income to become, again, a diversifier. So no surprises here. Active risk. right side of the page, chart number 2. That's actually more interesting. Just to remind you, we said that the active risk in your portfolio is at 2.1%. But what you see, it's all blue. It's all private. So private equity by far beyond is the single largest contributor. And why so? With benchmark private equity against the Russell 3000. It's not necessarily a representative index. It's a good measure of returns, but obviously we know that private markets behave very differently from public markets. And that's why this band, this blue band, is so wide. You also see that fixed income is actually a detractor, which again, the same thing I mentioned before. In this case, it's not very helpful. It is what it is, that's the markets. But it means that you may expect that fixed income will detract from excess returns. And that's again, a reflection of positive stock bond correlation, something we expect to revert. You see that cash, the red line, is actually a meaningful contributor. It's small, but it's there. But where's public equity? It's this thin green band. You can barely see it. What it tells you that in the current environment, you do not expect any meaningful excess return coming from the public equity managers. And we'll see later in the presentation the impact on performance. Okay, so let's dive more into the portfolio and see, thank you. See what actually compose what the distribution of fees at the more granular level. So let's focus on chart 1 at the top of the page. So here you see the portfolio split against the main buckets. You see the public equity, public fixed income, and alternatives. The blue bar represents the portfolio. The orange bar is overweight, underweight. And of course, we have cash, which is always overweight because there's no benchmark allocation. The important answer to this chart, you can barely see orange. The portfolio is managed very tight to the benchmark. You also notice that these numbers are slightly different from what Skip just showed you. That's because we show it without parking place adjustment. So we'll show the actual exposures against actual benchmark, which is more relevant for this discussion. Next, at the bottom of this page, we dive into each individual asset class. First, public equity. Again, all blue, all portfolio, not overweights, underweights. So check. Fixed income, the same thing. You can see it's meaningfully, it's tied to the benchmark. And then alternatives. That's where you see small differences, hopefully not a big surprise. So we know that private equity runs slightly above allocation, and specifically infrastructure is running slightly below. But again, hope no surprises here. We talked about this, and it's just another affirmation that the portfolio is managed as expected. Next, can we have next page, please? Thank you. So then we dive more into risk. Remember, I mentioned before that risk exposures are not the same as physical allocations. So what goes, what gives? So here you see your portfolio split along the same dimensions as the strategic benchmark. So it's consistent with the asset allocation. The blue bars represent allocation, dollars. The orange bar represents risk or expected performance. Two things stand out. First of all, two asset classes punch well above its weight: US equities and private equity. So we said before that equity is the most important driver of your returns and risk. What we see now, that's actually US exposure that drives most of your exposure, given that private equity is primarily domestic. Again, not necessarily a bad place to be. I mean, domestic markets prove to be the best performer over a very long time. It's probably the strongest economy out there with probably the best expectations. Fixed income, you can barely see orange, it disappears. And that's inconsistent with what we saw before. Fixed income acts as a balance in the portfolio, but what we do not see fixed income going down. We do not see the diversification effect. So fixed income currently is not delivering what we want to deliver. Okay, can we have the next page, please? And Here we dive more into the performance and these exposures. We're going by individual asset classes. And I keep saying that risk and performance are essentially the same thing. But we need to make sure that the risk as we projected is consistent with the performance. Why do we need to make this? Because first of all, we need to make sure that your portfolio is captured properly in the system. We make meaningful projections. Let's get another check to understand if there's something unusual happening in the portfolio. So first of all, starting with the total risk, which is measured absolute returns. So you can see that at the top level, at the system level, the risk for the portfolio is 12.4%, as we just talked about. The performance is 13%. So just as I said, risk frames the performance. You can see it's consistent. It's a good check. Fixed income. And I'm sorry, one from the top, equities. So high levels of risk, high level of returns. In this case, it's all negative, but you can see that it is consistent. Again, check. Fixed income. Risk is lower. The returns far exceeded our forecasts. And why is that? Again, going back to Steve's point that this is probably the most unusual fixed income market since the 18th century. We do expect that our risk forecast will not provide a good projection. Just as I said, there's a 15% probability will exceed our forecast. We're clearly within this 15% environment. These are very unusual times. And finally, the alternatives. High risk levels, high returns. One standout here is private real estate. So you can see the risk level projected about 14%. The returns, positive, it's a good surprise, exceeded our forecast by a huge margin. What it tells you that, as good as it is, we probably cannot count on this performance. At some point, it's likely to revert. Next, we'll look at the active risk, which again is a measure of excess return. So at the system level, the active risk was 2%. First of all, let's focus at the public asset classes. Equities. Active risk is 1%. It's low. We saw that. But within this bucket, there are some notable deviations. The US exposure is low, and that's because the majority of your exposure is in, at least capital exposure, is in the index funds. Developed ex-US, high levels of risk, 2.9%. That's because you use active managers. How does it translate into performance? You can see it in this column. The high level of risk for developed ex-US translates into high level of performance. Without mentioning any names, it's not allowed. It's not entirely unexpected. And again, I see it as a validation going back. It's a 15% probability we'll break through this bounds. That's what it is. On the fixed income side, on the other hand, you can see that active risk aligns very well with the performance. High yield is small deviation, but given the nature of the asset class, it's understandable. On the private side, I would say I wouldn't necessarily focus on excess returns, given that the benchmarks are not representative of this asset class. You know, they're big numbers, but they're not really telling us. All right. Can we have the next page, please? So we talked about the portfolio as it stands today, and we saw that it's broadly aligned with the investment policy statement and what is intended. What about the future? That's obviously a difficult question because we don't have the crystal ball. We don't know what the future will bring. What we can do is estimate how the portfolio will perform under a broad range of shocks, stress tests. So for this purpose, we identify the main factor in the market that may drive the performance in the future. What are the main events that may happen? And broadly speaking, it's the equities, rates, and the broad economy that will impact the markets in the future. And by broad economy, we proxy by commodities. which is a market proxy for everything that's happening out there. Within equities, we selected these three markets. First of all, obviously, the United States, the S&P 500, the emerging markets, MSAM, and Europe. So between these three markets, we cover about 70% of the global equity capitalization. It's a broad representation of the global equity markets. On the rate side, we picked, first of all, the 2-year Treasury. And this is really a proxy for the Federal Reserve. So even though it's 2 years as our short maturity, that's where market expectation usually traded. So this is a blend of what Federal Reserve is doing and market expectations about the future rates policy. The 10-year Treasury is a proxy for the broad economy. So that would determines the mortgage rates, corporate borrowing. It's probably one of the most important rates for the real economy out there, non-financial, but for real economy. And then the dollar. So obviously, US dollar has a very special place in the global monetary system. It's the world reserve currency. We're proxied by the dollar-euro exchange rate. In the real world, the non-financial world side, first of all, we focus on the copper prices, and copper is one of the best proxies for the GDP, for the global GDP growth. Almost anything being manufactured requires copper. So price of copper reflects the future expectation and future demand. Oil goes to pretty much anything. And inflation, which is obviously something we've been talking about for the past 2 to 3 years. One of the biggest concerns for everyone. So given this choice of market factors, we try to estimate what will be the worst monthly performance in the next 12 months. So we run this analysis using our risk system, bar one. This is not a forecast for the future. We don't know what the markets will be. Instead, the question we ask, what will be the worst monthly move consistent with the current market environment? You can see the answer right here in this column, Q4. So I want to pause here, first of all, to appreciate the size, the magnitude of the shocks. They're truly enormous. Just look at the averages. So we see this a material likelihood that over the next year, the equity markets will move by about 30% in 1 month. It's a huge move. It can be up or down. Among these three markets, you see that emerging markets in the United States are roughly the same, but Europe is a much higher risk. There's more likelihood of a larger move in Europe. And as you can see, compared to the last quarter, this risk went up. It was a material increase. On the rate side, you see that the numbers are equally staggering. For the 2-year Treasury, 140 basis points. It's enormous. It came down slightly from the previous quarter, but still, we're talking about big numbers. Same for the 10-year Treasury, big numbers. The dollar exchange rate, almost 11%. Like if it were 3-5 years ago, these numbers would have been unthinkable. The same magnitude also, if not more, for the real world. Copper, 35% move. Oil, 57%. But you can see, like here we show the last 2 years of history. You can see why these numbers are not out of thinkable. Oil went from being negative to 120 within the last 2 years. So that's why our forecast gives such a huge range of possibilities. So what does it mean for your portfolio? Can we have the next page, please? So for 9 factors that we identified, we ran stress tests by checking them up, which is risk on, or down, which is risk off. We do it for the portfolio and for the benchmark. So altogether, we present 36 stress tests. And the number, I'm not going to read all the numbers here, but several things clearly stand out here. First of all, let's focus on the equities. The S&P 500. That's your largest exposure. And you can see it's not surprising given that we have domestic bias in the portfolio. But domestic bias does not necessarily mean that the companies will derive its revenues domestically. The majority of companies in the S&P 500, for example, derive a material fraction of their revenues from abroad. So So if anything, it's an affirmation that again, everything aligned as expected. I also have a lot of comfort knowing that most of your exposure come actually from domestic equities. You have less exposure to Europe, material but less. Most importantly, your exposure to emerging markets, which means capital is China, is actually low. Given that certain future by the Chinese markets, it's actually a good outcome. The way exposures played out. The rates button. It's actually probably one of the more interesting outcomes of this exercise. So you can see that the exposure to a 2-year treasury, which is a proxy for the Federal Reserve decisions, is actually low. It's only 1.6%. It's not the Federal Reserve that directly drives exposures or returns in your portfolio. What's more important? The dollar. So if you read the news, as you follow papers, of course, we'll focus on Federal Reserve. It's actually the dollar and the role of the dollar in the global economy was probably more important to the returns in your portfolio. And finally, commodities, the economy. It's copper. Copper is the most important by far. And why it's so? This is because your portfolio is positioned to grow. So it will benefit in the high growth environment as your GDP expands. Maybe somewhat counterintuitive, an increase in inflation is actually positive for the portfolio. And why this is so? It's simply because as inflation goes up, the nominal GDP is expands as well, which drives up the revenues for the companies. So what are our main takeaways from this page? So first of all, it's another confirmation that performance of your portfolio under extreme stress, under extreme shocks, will be consistent with expectations. You see that the portfolio is positioned at slightly higher risk level as the benchmark. And why I say that, in the risk-on environment, the portfolio performs better than the benchmark. In the risk-off environment, the portfolio performs worse than the benchmark. So what we say that the portfolio is more risky than the benchmark. You also see that the portfolio has little downside protection. When I said that, again, the excess return and actually total return for the up or down stress test is roughly the same. And you can see that again, flip side of it is that portfolio outperforms in the upside and underperforms in downside. But the magnitude of this overperformance is actually not that high. You can see that under all scenarios, the excess return is 1% or less. Again, it's consistent with what we saw previously. And finally, just dive slightly more into these tests, much like we'll look at the portfolio in more details. Go to the next page, please. Thank you. So here we show the 3 most important scenarios, broken down again by the dimension of your strategic benchmark. So we show the S&P 500 stress, the dollar stress, and the inflation stress. Now keep in mind, all these stresses, all these scenarios have the same likelihood of happening. So first thing you get to notice that obviously you get more bang for the buck from the equity stress, right? You can see that simply because these bars are much higher for the equity. You also see that on the equity rally, only a few buckets in your portfolio perform well. On the rates and inflation scenario, the gains are more equally distributed. You can see that the fixed income provides little diversification in the portfolio. And why is that? Because obviously you can barely see core fixed income or tips under these 2 scenarios. On the inflation, this is a small negative bar, but it's really small. Again, it's consistent with what we talked about when we looked at the decomposition of risk in the current environment. And finally, you can see that the future performance of this portfolio is again consistent with our forecast, consistent with the risk as we see them today. You see that, believe me, it's too many numbers, but all asset classes under all scenarios perform consistent with our forecast. And that is another affirmation that going forward, your portfolio will perform as expected. So I'll stop here for any questions.
Any questions? Thank you, Ed. Well done. Well presented. So I think, thank you, Ed, again. Now we will ask for a motion to go back into executive session, I think.
For real this time.
So moved. So, do I hear a second?
Second.
And all those in favor of going back into executive session, say aye.
Aye.
Those opposed say nay. The abstentions. So we're now out of public session, waiting to go into executive. And in the meantime, we'll have a 10-minute break and maybe we can all be back by 10 after 12.
That's 15 minutes, that's great.
Oh. About 5 after 12.
I mean, I'll say.
Are we back into public yet?
You are back
Liz?
in public, yes.
And I guess now we're going to have a readout.
Yep.
By Ron Swingle.
Yes, thank you.
Ron.
Yes, in executive session, there were 2 manager updates. There was a discussion on an investment policy issue. Consensus was reached. We received preliminary performance data on the pension fund. And we received a presentation of the real estate asset class in which consensus was reached.
Thank you, Ron.
You're welcome.
Any questions? So I think we're at the time. Do I hear a motion to adjourn?
So moved.
Thank you, Mr. K. Do I hear a second?
Second.
Thank you, Ryan. Any discussion? All those in favor of adjourning, please say aye.
Aye.
Any opposed, say nay. Extensions? We are adjourned. I'd like to remind everyone that following this, we have an attorney-client session.